Welcome to Yahoo Finance. I'm Kristin Myers, and you're watching the ticker. Checking market action, all the major indices in the green. The NASDAQ, the leader on the day, up over 2%, with the Dow right behind, up over 1.5%, and the S&P 500 up nearly 1.5%. NASDAQ, of course, being led here by tech stocks. Checking the Yahoo Finance heat map today, we've got Microsoft, Apple up almost 3%, Facebook up almost 2.5%. Financials also doing pretty well. We've got Bank of America up 1.7%, JP Morgan up almost 2%. Of course, have to mention Tesla, which today is doing incredibly well, up almost 9.75 percentage points there. We also got some really great economic data today. From U.S. non-manufacturing activity, the new numbers out from ISM today grew to 57.1%. That's up from 45.4% in May. That's an increase of 11.7% for anyone that is counting at home. Now, this is the highest level that this number has reached in about 4 months after straight periods of contraction for the last 2 months. And as we can see, the markets are absolutely loving it, and we're seeing a rally today. So to dig more into this and what we're seeing today in the markets, we're joined now by John Porter, CIO of Equity at Mellon. John, thank you so much for joining us.
You're welcome. Thanks for having me.
Now, in your note today that I was reading, you said, in the face of all the unknowns, I am surprised and impressed by market strength. I would love for you to dig more into some of that sentiment. Why are we seeing the markets do so well when seemingly the world is on fire?
Boy, that's such a key question right now. This is example about 1,000 I've seen in my 25-year career of why predicting short-term market moves is so difficult. Look, investors are very rightly impressed by improving sequential data points. There's, at this moment, optimism about a vaccine. But we're a long ways away from being at a run rate for the broad economy that's similar to where we were at pre-COVID. The Fed is playing a significant role in capital markets today. That's very clear. Really, all of the stimulus that we've seen, both fiscal and monetary, is an outside driver of current market levels. Can the market rise from here? Well, absolutely. Of course it can. But our job is to really assess the odds, to weigh the risks. And I would say right now, current prices seem to have a lot more that could go wrong with them than could go right.
So to that point on stimulus, right, we just got an extension on the PPP, but stimulus is not going to be around forever. We have a fight gearing up between the Republicans and the Democrats on what stimulus is going to look like in terms of people receiving those checks. What happens to the markets then when all of this goes away in just a couple of months and that's not fueling this anymore?
Well, I think one of the key questions is, the premise of your question is, will it go away in a couple of months? I think we've seen both parties wanting to try and kick the can down the road and not making the market face the reality of unwinding the stimulus. So I think that the stimulus programs are likely to be renewed and extended, certainly until we get closer to the election. But the heart of your question is an important one. The way I'm thinking about it is sort of a baton handoff. There needs to be a handoff from the stimulus-supported economy to one that's back on its own 2 feet. And that's going to be a very challenging path. There's going to be a lot of ups and downs to getting this economy restarted. When we're seeing that right now, I think that's only going to continue as we move through the year. There's lots of open questions. Will schools reopen? If schools don't reopen, it's hard for parents to go back to sort of normal work lives and many other key questions I think are going to make that baton handoff very difficult. And again, that's one of the big unknowns that I don't think current market levels are reflecting very well.
So I want to talk to you then about just looking out the next couple of months, especially on recovery. We've talked a lot about recovery. Some people are saying it's a V shape, it's a swoop. I'm now seeing that perhaps it's a W. What are your thoughts on what this recovery is going to look like, especially as we see these coronavirus cases spiking and some states saying we might have to go back into lockdown?
Yeah, I think the odds are it's going to be some sort of W or some sort of wavy shape. It's not going to be up and to the right. Again, we've seen that in states and in local municipalities that have started to reopen and then having to take a step back. I think that's a microcosm of what we're going to see in the broad economy. I mean, look, we talk to companies every day. It's what we do as fundamental research analysts at Mellon. And we're hearing from company after company that that the reopening process is going to be long and involved. It's one thing to shut your business down, to get it restarted, to get the supply chain in place, to get your employees back working, to make sure the demand is there, to justify your reopening plans. All of that is a very complicated path that we think is going to have some setbacks along the way.
So on that point about companies, because I want to ask you about what we're going to be seeing in just a couple of weeks with earnings, it almost seems like a lot of companies have a big question mark about what's coming up, over the next couple of months. So what do you think we are going to see, starting with the banks, out in just a couple of weeks when we hit earnings season again?
Well, certainly when you look at the massive run the market's had over the past 3 months, it sets the stage for a possible sell the news reaction to corporate earnings. As I've said in talking about the other issues, visibility is really limited right now for the vast majority of companies. We expect that while companies, may report better than expected earnings for the calendar Q2, they're also going to be emphasizing how cloudy their crystal ball is. This is something that we think could be a short-term setback for markets.
So John, I know I'm running out of time with you here, but I want to ask you about some of my favorite investors in the market, the mom and pop investors. I know, and I'm sure when they see a rally like today, it gets them excited. I saw again in your note that cheap does not always mean safe. So for those investors out there, why do you say that?
Yeah, the point there is if you look at what's going on in sort of the growth versus value tug of war that's happening in the markets, it's clearly being won right now by the growth stocks. One of the concerns about the growth stocks is how expensive they are. And they are expensive, don't get me wrong. But this is not the tech bubble 2.0. The expensive companies today have much better business models than they did before. Those companies that are the market leaders have much better returns on capital, much better cash flow generation characteristics than they did in the past. And one of the ways you're seeing that in the market is they're exhibiting low beta. When you look at market pullbacks, some of these high growth and expensive companies have been the safe havens in market pullbacks. We've seen that as this entire year has played out. Certainly in the downturn, from late February to late March, those high growth, high valuation stocks are actually some of the best places to hide on a relative basis for the market. And some of the worst places to be were those companies that optically looked very cheap, but many of those cheap stocks have a lot of economic cyclicality. And again, right now, with all of the economic uncertainty, I would be careful about those companies that optically look cheap.
All right, we'll have to leave that conversation there. John Porter, CIO of Equity at Mellon, thank you so much for joining us today.
You're welcome. Thanks.